guys, it's Markets with May, and in this episode, we're going to talk about 4 different styles of fundamental investing. I want to do this video because I noticed on blogs, the Reddit boards, and YouTube videos that there's this concept that there's only one way to do fundamental investing, and as a result, there's a bit of confusion that I've noticed and even some bullying that I've seen. There isn't just one fundamental type of investment and then everybody else is a day trader. And we're going to group 4 different types of fundamental investors in a rough sense to try to give you a framework to think about it and also decide for yourself what might be your format ultimately of making investment decisions. Now, these are groupings that I have largely made up, and I'll fit in different styles of fundamental investing within them. But they should help create some framework, whether you ultimately decide to do the work yourself, or if you're investing and maybe vetting a mutual fund manager or someone else to manage your assets. Now, in all of these cases, you may do exceptionally similar work. It's just that the inference and the stresses are going to be in very different places. And then how you think about where you even source ideas is also going to be very different. Now, the first type of fundamental investor I'm going to talk about is your classic valuation-based fundamental investor. It's probably the most common one. Now, the second type of investor I'm going to talk about is the corporate action fundamental investor. And they've got a totally different way that they're thinking about it. Now, the third type of fundamental investor I'm going to call the activist fundamental investor. And the fourth bucket of fundamental investors I'm going to talk about are those that think in terms of opportunity costers. Now, these are just my own terms, but anyone that's doing valuation work, and certainly anyone that works in the options market to help people hedge risk, are going to need to think in these terms to make investment decisions. Now, the first bucket of investor, the classic valuation investor, is just trying to figure out, is this company cheap or expensive relative to what I think it ought to be worth? Now, what I think it ought to be worth might be derived using a discounted cash flow model. It might be doing some sort of relative valuation using relative metrics. It might be any number of things, but really the belief system is this is a good company. There's a set of earnings that's going to happen. That earnings is going to relate to some sort of growth rate. I have some thoughts on how much I should discount the company's ability to accomplish that, so on and so forth. You're going to use a lot of the metrics that you hear about all the time: price to earnings, price to sales, et cetera, et cetera, et cetera. What is the growth rate compared to these metrics? That's going to be a classic valuation approach to trying to determine if a company is under or overvalued. It's probably the one you hear about the most. Now, the second bucket of fundamental investors, I call them corporate action fundamental investors. These folks are going to pick industries and areas where there's the potential for corporate action that isn't obvious through just pure, I'm doing the valuation work on the company. These types of folks are going to look at takeout valuation. Perhaps the company's been brutalized because that industry is not interesting, and it might, instead of being in the public markets, make more sense in the private markets. So such a person is going to also want to understand the landscape of the private equity markets themselves and what those folks might even bother to buy. And then they're going to want to really understand a lot more the acumen of different managers that you could put in place. Now, other things corporate action oriented fundamental investors might be thinking about is they might be in an industry because they believe a lot of mergers and acquisition activity is going to take place. And in that regard, something may look ugly on a pure classic valuation perspective, but once you realize and assess that maybe they were just missing this one thing, which is if they got bought, the sales team costs would go down dramatically or operational costs would go down dramatically. That sort of thing is going to be in the purview of this group of people. To make it really simple to kind of think about it, one of the most common places that you'll see this kind of corporate action type investment is in healthcare, especially with a lot of small cap drugs, small cap medical device development, that sort of thing. It's very common for these companies to run really ugly balance sheets and income statements. Then they get approval through the FDA and they just get taken out. And what the folks that are specializing in this are really good at is understanding what something might be worth at different stages, at different specific events. Now, In the business, they might also call this event-driven, something like that. There's lots of different names for it. But these folks are not doing a classic DCF by itself in the same way with the same interpretations. Now, the third bucket that I would talk about is an activist. And in some ways, they as well do a lot of the similar things as my corporate action folks and also my classic DCF folks. But what an activist investor is doing is they're looking at a company and figuring out if there is a problem, quite frankly, that can be solved by just having either a stronger management team or a single specific investor that can push something through that hasn't happened. In an antagonistic scenario, this is going to be replacing the management team because there's a vote of non-trust that management team's strategy is in the right direction. In the uglier cases, as with movies like Wall Street, you have an activist coming in who's more like a raider, and they are looking at something like book value and thinking that the best way to get the value out of the company is to actually just sell off every single part of it and break it up into pieces, break up value. And in that case, you might care more about book value. You might be thinking about ways to monetize the real estate. In these cases, though, one is actively listening for the idea that the strategy that's in place, given the pieces on the chessboard that the company has, is wrong. So they are fundamentally a bit antagonistic to management. In some small cases, they're not antagonistic so much as they have a whole lot of ideas that they would like to push through in addition to what management is currently doing. Now, another common question to the corporate action style investor that differs a little bit from everyone else is this concept of what would it take if I had to develop that division or that expertise myself? So, for example, something like Snowflake might be this style of thinking process because, Snowflake at $500 million is one of the few cloud businesses that is more or less just cloud, has some special niche within cloud that touches pretty much all the other cloud businesses and has some sort of strategic value, but doesn't necessarily make earnings and may be a little ugly if you tried to value it in a classic sense. But if you tried to grow Snowflake from scratch, you'd need a particular headcount that you may not be able to get. You need a particular team structure that you may not be able to have. You'd have to program it really, really fast. You'd still have to onboard those clients who are very sticky. There'd be this whole series of things that it may just be better to go ahead and outright buy the revenues or figure out some sort of corporate action that would allow a takeout to happen. Now, I'm not saying that Snowflake is getting taken out. Let's just be very clear. Now, the final type of investor I'm going to call an opportunity cost investor. And I differentiate it a little bit from the classic value investor because I think of it more like what Warren Buffett is doing, which he's deep value, don't get me wrong, but there is also some nuances to what he's doing. What he's doing is he's really most interested in how much cash that can yield him, period. So he's not valuing it in the sense that, oh, I think it'll grow, la, la, la. He actually wants the cash flow from it. And in the case of Warren Buffett, he's happy to take that company full in private so that he can then have the cash flow to allocate to other things. So the dividend becomes extremely important. Another way that these particular individuals might differ from the classic value analysts is they're far more concerned with cross asset class. So in other words, I could put $1 into this company and it will cash flow and dividend yield me this, or I could put my money into an inflation-linked bond, which technically the classic valuation folks do too, but not really to the same thought process and degree. Or I could put my money into a piece of real estate. I have some costs as far as headcount goes to try to manage it, or I'm going to have to manage it by myself, that sort of thing. The opportunity cost style of investor is not really thinking the same way as a classic valuation analyst is thinking at all. So the last thing I'm going to comment on is why is it important to have some sense that there would be these different styles of fundamental investing? And that really is because in any given company that's thrown at me, I've got to figure out what is the right way to value this company. And sometimes you'll be staring at a company and you'll be like, this thing is a total dog. But then when you just shift your lens a little bit as to that's a dog with some very, very undervalued assets, you realize that in fact, it totally does fit a concept of cheap or undervalued. Things that get cheap can get a lot cheaper. Things that are expensive may only be expensive under one lens, but not a different lens. Now, at different times, if you disagree with the market may be using a different lens of fundamental valuation to think about that company. Or it could just be a meme stock. I mean, either is possible in 2022. But it serves you very well if you're going to be a fundamental analyst to realize that there can be other fundamental analysts that think about it very differently, even if they're staring at the same numbers that you are. That's all I have prepared for today. I would love to hear what you think about valuation work that you might be doing in the comments. Again, it always is so helpful if you'll like, share, comment, or subscribe to my channel. It lets me know what kinds of stuff I should be making. And until next time, be careful out there in those markets.